Until very recently, zinc has held the position as the weakest performing base metal in 2025, with loosening fundamentals and low investor interest limiting price gains on a global basis. However, over the last quarter, the outlook for zinc has altered, and it was the best performing base metal in Q3, with year-to-date gains now in the green at 2.3%. This is being driven by demand outside of China, resulting in consistent LME warehouse outflows since mid-April, most significantly from Singapore warehouses. Indeed, at the back end of last week, LME closing stocks stood at just 35,300 tonnes, their lowest level since March 2023, having fallen by 85% on a year-to-date basis, covering less than 1 day's worth of demand. In turn, this resulted in zinc posting its widest backwardation on record of $339 per tonne by the 22nd of October, with the forward curve recording widening backwardations out to December 26. Unlike in 2024, when we saw whipsaw movements in material being cancelled and then re-warranted in LME warehouses, particularly Singapore, as a consequence of trading houses and warehouses engaging in rent share deals to split storage fees, this time around, material which has been cancelled appears not to be coming back. For example, on a year-to-date basis, Singapore on-warrant stocks are down 140,175 tonnes versus a net import of 26,875 tonnes during the same period in 2024. Meanwhile, if we examine net trade of zinc ingots in Singapore over the first 7 months of the year, total exports stand at 189,700 tonnes, exceeding the total volume of exports in 2024, which stood at 154,500 tonnes, while net imports so far this year stand at just 28,900 tonnes, down 81% versus the same period in 2024. If we examine Singapore customs data, the majority of metal pull has come from Southeast Asian countries, such as Vietnam, Malaysia, and Indonesia, in addition to India and the Middle East. While some material has also gone into Europe, where smelters' margins suffer from high energy prices and a lack of ore availability following 3 years of global mine production having been in decline over 2022 to 2024. In addition to this, while some excess material will inevitably be re-exported from these countries above to feed other end users, this year is unique in its own right, in which US tariffs are playing a role. Here, we're talking about the ongoing Section 232 investigation into critical minerals, which was launched in April, that could result in import tariffs on zinc, in which the US has the highest import reliance of any refined base metal, standing at 75%. With the investigation having 180 days to run, the markets were expecting an announcement this month, accelerating the desire of market participants to take advantage of high domestic premiums, altering historical trade flow patterns. In our view, we expect the tightness in the zinc market to remain until we start to see one or multiple of the following scenarios unfold, likely to keep prices in a tightly higher trading range around that $3,000 per tonne level. Scenario 1, we see Chinese smelters take advantage of the ongoing arbitrage between China and the rest of the world. Indeed, on the 24th of October, Shanghai Metals Market predicted that Chinese exports to LME Singapore warehouses or to Southeast Asian spot markets would incur profits. Looking at the most recent monthly data, Chinese refined exports in September jumped to 2,748 tonnes, almost a 700% month-on-month jump, with Shanghai Metals Market expecting exports to rise to 10,000 tonnes in October. However, we are cautious here that this export window won't remain open for long. Scenario 2, if we see profit taking from current dominant long holders. As it stands, there are 4 dominant long holders based on LME data, which cover 170% of zinc stocks. This is down from 6 holders posted on the 20th of October, which at that time held cumulative cash positions amounting to 300% of the level of stock held in the LME warehouse. However, if said holders face no immediate liquidity pressures, then there may be little incentive for them to release material into the market, especially with annual benchmark and long-term contract negotiations yet to be finalised for 2026. And scenario 3. We receive a ruling on the Section 232 investigation into critical minerals. Here, if no tariffs occur on zinc imports, then we could see metal in the US return to LME warehouses. However, the opposite is true. In this scenario, we have sustained domestic high premiums because of new tariffs, with material in the country likely to remain where it is. Please note we do not expect a ruling on this until the government shutdown is over. Over the course of 2026, we see zinc prices pulling back from these $3,000 per tonne levels, with increasing supply and still a modest demand outlook, allowing global stocks to return to more balanced levels. This is especially true when we account for the domestic view on zinc in China, which is more measured, with plentiful inventory, Shanghai Future Exchange stocks well above 5-year averages, and robust production, up 3.9% on a year-to-date basis, versus a rise of just 0.8% in 2024. With this set against a weak outlook for zinc's largest end use, the construction market. However, to year-end, the outlook is more complex and a question of timing when it comes to physical logistics. We expect backwardations to persist over the month ahead before softening, underpinning prices and indeed volatility in the very near term.